Hello, everyone, and welcome to today's virtual webinar. My name is Margaret, and I will be the web host for today. We have a few housekeeping announcements, and then I will introduce our speakers. As a reminder, in order to earn CPE credit for today's session, please stay connected to the webcast for the entire program and participate by responding to at least 3 of the 5 interactive questions. Second, there will be a course evaluation, which will open in a new window upon exiting the webcast. With that, I will introduce our speakers. Kevin Jacobs is a managing director with Alvarez & Marsal Tax, LLC in Washington, D.C., and the National Tax Office practice leader and the U.S. Restructuring Tax Services co-leader. He brings more than 20 years of experience in tax matters in both the public and private sector. Kathleen King is a managing director and national R&D practice leader with Alvarez & Marsal Tax, LLC in Washington, D.C., with more than 25 years of experience. Ms. King specializes in assisting clients across various industries, specializing in claiming, documenting, and sustaining tax incentives. Braith Myers is a managing director with the National Tax Office of Alvarez & Marsal Tax in Washington, D.C. He brings more than 14 years of accounting method experience to A&M. And prior to joining A&M, Mr. Myers was a member of the National Tax Department of a Big Four accounting firm, advising clients on a wide range of U.S. federal income tax issues. And finally, Nate Jones is a lead product manager with Wolters, Kluwer Tax and Accounting. He will be showing us today how to find additional answers and resources using CCH Answer Connect. Thank you all, and Kevin, take it away.
Great, thanks Margaret, and thanks everyone for joining us today. Realizing we switched platforms, we're still working out some kinks, so if there's any technical glitches, apologies, but hopefully you all will have an enjoyable experience with this webinar. We thought we'd start out today with an overview of the OBBBA. Some people are calling it OBBA, some people are OB cubed. Take your pick, but we'll talk about the bill at a high level and what are some of the key takeaways. We'll then turn to the focus of this presentation, which is the sort of the big 3 TCJA provisions that were touched upon: the business interest limitation, the R&E expenditures, and the accelerated depreciation. We'll then start thinking about what's next, and then Nate will walk us through some of the benefits of how you can further research using Answer Connect. So let's talk about it. And everyone knows the bill already. The bill was enacted on July 4th. President Trump had the desired White House ceremony that he wanted, but it really was a matter of, we had a budget reconciliation process. Now, that budget reconciliation process, and we talked about this previously, was a streamlined process in order to get the bare minimum, a majority of the votes to say, okay, enough Republicans can support it, we don't need any Democratic support, in order to get this process, this bill through. Now, when thinking about this bill, it's interesting that the latest scoring has suggested that it's estimated to increase the deficit by approximately $4.5 trillion. Now, it's in, if you look at history, historically, whatever estimates they have from a cost perspective always are under and revenue is over. So if you say, okay, what is the current estimate? The current estimate is increasing the deficit by approximately 4.5 trillion. If history repeats itself, that means that if we go back and revisit what actually the implications are, that the deficit will actually increase by multiples of that number. The key takeaway is it was really controversial for its process, not necessarily the reconciliation process itself, because that has been done by both parties of late, but really how they got across the finish line, right? And you can see here the bird bath was something that we talked about previously when they were going through the reconciliation process as to, okay, only certain provisions can actually be included in the bill. But the last minute deals that they struck, really to get it across, when President Trump was on the campaign trail, he continuously said, okay, we want to drain the swamp. We don't want to have any sort of pork in any of the bills. But you could see a host of side bills that were, or agreements that were entered into as part of this process. there are substantial costs without offset, right? And so now what we need to think about is, where does this leave us? We're going to talk about that in a few minutes, as well as towards the end of the webinar. But what besides the key three should people know about? Well, there's the international tax provisions. The international tax provisions were guilty-fitty. They changed the implications of how these things are calculated. In essence, there is not an easy way to determine who is the winner or loser. Because of the changes that are here, it's important to be sure of having a model as to what are the implications for each individual taxpayer. We've seen situations where some taxpayers' effective tax rate is going to be much less under the international tax provisions, while other circumstances, they're actually going to be much more. And so just flagging for you, it's not necessarily a one-size-fits-all approach. Energy tax provisions was something that's been there. Obviously, we've just seen some additional guidance that came out literally before the webinar came out about beginning construction. And so energy tax provisions was a hot button issue, as well as, the SALT cap was a major issue. The provisions that weren't included in the bill are also noteworthy, right? In the sense of President Trump had articulated that he wants to change the corporate tax rate. That wasn't included in here. He articulated he wanted changing period interest. That also wasn't included in there. And then a major hot button issue for multinationals was the 899 retaliatory taxes. And so we'll touch on that later on as far as the implications. But you can always have a new reconciliation bill, right, that impacts taxes at either revenue or cost per legislative calendar. So that always means that once we have a new legislative cycle, you can have another reconciliation bill. So this is going to actually prompt our next or first polling question that you have to answer in order to get CPE credit is, will the Republicans pass another reconciliation bill that changes the Internal Revenue Code in 2025? So they are able to, from a time perspective, able to do it, but whether or not they are going to do it is really the question. So hopefully that polling question has been launched, and make sure that you're submitting it. I guess while the audience is answering, why don't we turn our attention to the business interest limitations? What should they know about 163J?
Lots of stuff is the short answer, Kevin, but let's set up with a little bit of a background to level set with everybody. So Section 163J, right, which is the limitation on business interest expenses, prior to OBBBA, limited the deduction to the sum of taxpayers, business interest income, 30% of their adjusted taxable income, or ATI, as you see on the slide, and as well as the amount of floor plan financing interest for certain vehicles, which is really just the interest from debt that finances the acquisition of certain motor vehicles that taxpayers hold for sale or lease to customers. Prior to 2022, as you likely know, ATI was calculated using a tax EBITDA formula, in which taxpayers were permitted to add back their depreciation and amortization. But then in 2022, it changed the formula to be a tax EBIT formula, where taxpayers were no longer allowed to add back the depreciation and amortization, which further limited the amount of interest they could deduct. Additionally, certain taxpayers can make an election to be an accepted trader business. The most common one that I've seen in practice are businesses that are classified as real property trader businesses. And the significance is in electing to be a accepted trader businesses, such as a real property trader business, is that you're no longer subject to the 163J limitation, but you have to forego certain favorable accelerated depreciation by making that election. And additionally, the election, once made, is essentially irrevocable. So that takes us to OBBBA, and there's sort of two buckets of rules that are coming online. So beginning in 2025, OBBBA changes the 163J calculation back to a tax EBITDA amount, similar to the pre-2022 calculation that I mentioned. So the consequence there is that taxpayers get to add back their tax depreciation and amortization when they're calculating the 30% limitation. As a result, if a taxpayer, for example, has $1 million of depreciation, when they add that back, they're essentially going to be permitted to deduct an additional $300,000 of interest for that depreciation that is running through beginning in 2025. Additionally, the second item coming online for 2025 is that floor plan financing is expanded beyond just the motor vehicles to include certain trailers and campers. And generally those are trailers and campers that are designed to be towed or fixed to a motor vehicle. So there's an expansion of taxpayers that may be able to exclude themselves from the 163 limitations. For 2025, we've seen a couple of questions come in, particularly around those accepted trader businesses. So once taxpayers had to move to an EBIT calculation, certain taxpayers, particularly real property trader businesses, maybe made an election to become an accepted trader business. But now that they can add back their depreciation and amortization, they may be eligible to deduct more interest under the favorable EBITDA rules. And the question is really, as I mentioned, accepted trader businesses, once you made that election, you're stuck with it and it's irrevocable. So the question is sort of, do we think IRS will give permission to revoke their election? Certainly, I don't know, but it wouldn't be the first time that in guidance, IRS has provided guidance allowing or permitting taxpayers to make a election or to revoke an election, particularly when there's a change in law. So it's certainly on the table. We'll obviously have to wait to see if it comes to fruition. Then the second bucket of items sort of come online in 2026. And so beginning in 2026, OBBBA makes sort of two changes that you'll see here on the change. And, both could significantly impact taxpayers or your company, depending on your situation. The first is that the ATI calculation is modified to exclude CFC income inclusions, essentially, and the corresponding deductions related to the CFC income inclusions. So for those U.S. taxpayers or U.S. shareholders with CFC income, this may result in them decreasing their ATI and reducing the amount of interest that they may be eligible to deduct, depending on the numbers. The second significant change beginning in 2026 is that OBBBA provides ordering rules so that Section 163J limitations are applied prior to any elective interest capitalization provisions. And so, beginning in 2026, it's going to be clear that you have your mandatory 263 Cap A interest capitalization provisions applied first, then you're going to apply your 163J limitation second, and then third, to the extent you have any interest that is eligible to be deducted and not subject to limitations, you could make an election to capitalize that interest if you so choose. So that will significantly impact taxpayers' planning opportunities around the 163J limitations.
Yeah, so Rafe, a few things just to chime in.
Yeah.
When I was at the service and we were implementing TCJ, the initial 163J, to your point, the service was always mindful of change in circumstances, change in law when trying to figure out allowing taxpayers to change their mind. So definitely agree with the analysis that you're suggesting. We're on the lookout for that guidance coming soon. On the adjustments, it is sort of interesting when you think about what they might have been trying to do and hearing from some people what the intention was, which was, when looking at the foreign income, they were concerned about a double benefit, which is the CFC, which generates the subpart F income or the net, that actually has tested income, is subject to 163J. And so they were concerned that that same income is springing interest deductions at the CFC as well as the US shareholder. And that's the reason for the exclusion. Now, it's interesting when you look at the international regime and you compare how a domestic corporation is treated versus a foreign corporation. A domestic corporation, right, you don't have the equivalent of subpart F or formerly guilty, right? And so the domestic corporation was subject to its own tax. And then ultimately, if it makes a distribution, that dividend gets included in taxable income of the shareholder, and therefore it increases their ATI. The premise of subpart F and the guilty regime was to say, we're trying to create sort of a deemed dividend construct. Now, by virtue of them excluding it, you do have that foreign corporation subject to 163J, similar to a domestic corporation. However, in the foreign corporation regime, when it makes a distribution up to that shareholder, there is no general inclusion in taxable income because that's already previously taxed earnings and profits, or PTEP. So therefore, that distribution, an actual distribution, will never be able to increase the amount of the 163J on the US shareholder. So it is just this really interesting provision that they put in here. And we're just trying to be mindful and highlighting here, where it is. Now, on the capitalization and the ordering, I do think it's also important to note that the law does say no inference is supposed to be read into from what it was before when, this change in OBBBA, right? That's significant because the market has generally taken the view that you're able to capitalize before applying the 163J limitation. So until this is applicable, so for taxable years beginning that do not begin after December 31st, 2025, you're still able to potentially make the elections for capitalization. And that's important not only for calendar year, but also obviously for fiscal year taxpayers. So just trying to be mindful of how the rules do apply.
Yeah, great insights, Kevin. So on the next slide, we have a very simplified example on the impact of 163J, and it sort of illustrates two things. First, scenario one illustrates the ability to add back depreciation and amortization in calculating the 30% limit. And then in scenario two, it provides, and you can see the additional benefit that can be obtained if a taxpayer is able to capitalize and depreciate or amortize additional costs. Obviously, particularly with 100% bonus depreciation, which we'll talk about in a little bit, the ability to increase and recharacterize amounts as through depreciation and amortization can increase, right, the amount of interest that a taxpayer can claim or deduct. So here in the example, you still have the same amount of deductions, but $150,000 of what was ordinary necessary expenses in example one are essentially reclassed to current year depreciation, and therefore when it gets added back is increasing your ATI, and as well as increasing the amount of interest you can deduct. And so as you're thinking about how to implement and model these provisions, right, just be mindful of and thinking through what opportunities there may be for capitalizing and depreciating additional costs that maybe aren't currently being capitalized, so that you can further enhance the amount of interest you can deduct under these new EBITDA calculations. Any other insights on that, Kevin, that you want to share? Or?
Nope, I think we're good.
Okay. With that, then maybe why don't we turn over to Section 174 and Cap A and domestic research and experimental R&E expenditures with Kevin. Kathleen.
Thanks, Ray. And I am having some computer difficulties, so you'll be able to look at Kevin and Ray's pretty faces, but unfortunately, I'm frozen right now on screen. And but again, appreciate the opportunity to present today. So we're going to spend a few minutes just kind of reviewing the implications of the changes on 174, which relates to research and experimental expenditures. Again, just a level set, in many ways, we're going back to a TCJA type of rules in terms of for domestic R&D costs. You can generally expense those costs as incurred, which is, again, starting in 2022, taxpayers were required to start capitalizing all R&E costs. And we are now going back to the pre-2022 process in terms of at least domestic costs. There is still the requirement for foreign costs. And again, the whole purpose of this is they're trying to incentivize R&D work done in the United States. There is now a requirement that those costs still be capitalized and amortized over a 15-year period. There's a couple implications for this. One is that, again, we still do not have even draft regulations out for 174. They are still needed because of the foreign component that is going to continue on. Some of the key questions that are included in that are just some of the treatment from whether it's from a contract perspective or specifically the types of costs that need to be capitalized for these foreign R&D costs. Again, we got the notice 2023-63 released, but again, that was just still in the form of a notice. So I don't know, Wraith, if what you're hearing in terms of the guidance, but obviously with the continuing foreign requirement to capitalize foreign costs, that guidance is still needed.
Yeah, I would agree. I mean, I think, there's a number of relevant provisions that are outlined in the notice and a few subsequent notices that came out, and you hit on them, sort of what is software from a definitional standpoint, allocations between R&E activities or what's incidental to R&E and what's not, contract research provisions. I think those are all relevant provisions, probably both for 174 Cap A as well as 174 in the foreign context. So I would expect that, guidance would, be issued to cover these issues that are still outstanding, as well as some, additional issues that might pop up in the 174 Cap A context, whether it's, transition rules or, how to make certain elections. So I think it's still relevant, and I would expect them to still continue to work and issue guidance covering, research and experimental expenditures.
Yeah, I mean,
so
to
that
end.
Go ahead.
Sorry,
Kevin.
Kathleen. I mean, to that end, the guidance hasn't come out in part because there was always the discussion of whether or not 174 in its entirety was going to be changed, right? And so when the Treasury and the IRS was working, so it's not like they have to start from scratch, right? I mean, they've had a lot of input from the public on these issues, so it's really hopeful that we'll see this. Obviously, there's going to have to be further tinkering with because of the new changes that are here. And you can presume that I think they probably are going to come out with a total package as opposed to just one package, as opposed to multiple packages. But sometimes they do break it out and say, okay, we can get out piecemeal packages. But considering the interplay of the 174 and 174A, I think it's probably likely that we'll see just a package that addresses them.
Yeah, I think that's right, Kevin. I think I would envision sort of maybe two, tracks of guidance. One, the procedural track, I'll call it, and then one, the substantive track, which I think you highlighted. And from a procedural track, right, I think there will be questions around, right, 174 Cap A is treated as a change in accounting method. So they'll have to, there's certain elections within there. And so I would expect them to issue guidance addressing those procedural issues. How do you effectuate the change in accounting method? How do you make elections under new section 174 Cap A, and then also issue guidance that's more in the substantive nature as you've highlighted.
So, Ray, I guess specifically on the accounting method changes then, just to clarify, when we're looking going forward, I guess taxpayers are going to have to make a choice though, correct? Is their overall method going to be to deduct, or their overall method going to be to capitalize? There's not an ability to split the baby, so to say. Is that correct?
I think that's fair, Kathleen. I think that the statutory provisions don't necessarily clearly answer what happens if a taxpayer makes an election to say capitalize and amortize research and experimental expenditures over 60 months. Obviously, there was a lot of guidance and procedural rules in pre-TCGA, right? You had 174 little a, which was a deduct when paid or incurred, and you had 174B, capitalize and amortize over a period not less than 60 months when when a taxpayer first realizes the benefit. And under that regime, right, there is a lot of flexibility for taxpayers. And so it's not clear, I think, in the statute currently under OBBBA, whether that flexibility will remain. And it's obviously not clear if any subsequent guidance, procedural guidance, will leverage those prior rules and provide a lot of flexibility. So taxpayers could be in a situation, right, where an election to capitalize and amortize their R&E expenses could cover all their R&E expenses, whereas under the old pre-TCGA section 174B, you had the flexibility to make an election on a project by project basis. You could generally make automatic method changes almost annually because there's a waiver of the 5-year scope limitation that generally applies to method changes. So there's a lot of flexibility. It's not clear to me that will continue. So I think right now, I think the way the rules in the statute are outlined is that you probably are going to be subject, if you make an election, subject all your domestic R&E to that election until some subsequent guidance comes out that might provide favorable flexibility to taxpayers.
And one of the more, I guess, I call it controversial or questionable provisions under the prior legislation was 174D. Can you talk a little bit in terms of kind of how you see that evolving with the changes that have happened?
Sure. Yeah. For reference, as Kathleen mentioned, TCJ added, a new rule in section 174D that she referenced, and it provided that taxpayers essentially could not deduct any unamortized amounts on the disposition of the related property. And although I think it was, fairly clear taxpayers could not claim a deduction or loss when abandoning a project or, other similar disposition, the application of the 174D provision was really difficult to apply in various sales and transactions. And there's a lot of discussion among practitioners, and you had a lot of strange outcomes. And so section 174 Cap A, just to clarify, does not contain any limitation on the deduction on the disposition of any property related to the domestic R&E expenditures, which is a fairly significant benefit to taxpayers, particularly if they end up abandoning a project that has significant domestic R&E costs. But, OBBBA, as I call it, also updated Section 174D for foreign R&E. So, for foreign R&E, you still have the application of 174D, limiting the deductions. And they also provided that taxpayers cannot reduce the amount realized by the unamortized foreign R&E if they dispose of the underlying property. So as a result, taxpayers in that, for example, in an asset sale, would be prohibited from fully recovering their unamortized domestic expenses related to foreign R&E. And so that's sort of a significant, provision that's still in place for foreign R&E. And so you have almost two different rules depending on whether the R&E is foreign or domestic based, and the impacts could be significant depending on your situation. So definitely mindful of 174D still applying to foreign R&E, but you might have favorable outcomes with respect to your domestic piece.
So moving to the next slide, I guess we wanted to, touch on a couple things related to the upcoming changes. And I guess, Raith, I think you were going to talk about some of the implications for small businesses.
So there's a couple transition rules for domestic R&E under new Section 174 Cap A. And as you see on the slide, right, we have two different provisions. One for small taxpayers, small businesses that are essentially under the gross receipts threshold. And for those small taxpayers, they can elect to retroactively apply Section 174 Cap A for the tax years 2022 through 2024. And basically that will permit them to go back and amend their tax returns for those years to deduct the domestic R&E, only the domestic R&E, obviously, for one or more of those tax years. In contrast, there's a transition rule that applies to all taxpayers, regardless of size. And essentially for those taxpayers, they can make an election for the unamortized domestic R&E costs that they incurred 2022 through 2024 and deduct that unamortized amount over one or two tax years starting in 2025. So you could have a situation where a taxpayer is eligible to make an election to deduct their full unamortized domestic R&E costs in 2025, or assuming there's no short tax years, right, you could basically break it up and do 50% in 2025 and 50% in 2026. So it sort of raised, it's certainly beneficial for certain taxpayers and raised a lot of questions that we've received. Kathleen, I know you've had a handful of questions come in from small taxpayers considering amending prior returns to take advantage of the transition rules. Sort of mind sharing what you've seen and discussed with your clients?
Sure. So it was interesting that right after the legislation passed, again, I think the headline was, you can now deduct the costs. And we had some clients that fell under the small taxpayer definition that they hadn't filed their 24 return as of yet. And their initial question was, can we go ahead and just deduct those costs now? And the short answer is, and Raith, I know that maybe you've had some informal discussions where there's been some indication that maybe they would be flexible on this, but in general, based on the way the statute's written, our expectation is that for 2024 returns, you still have to capitalize those costs. But again, under these transition rules as a small business, you have the ability to amend those years and accelerate the amounts that were capitalized. I think that what we're generally advising our clients, though, is it doesn't make sense, again, in general, and you have to look at your specific circumstances to amend those returns. The reason why it doesn't make sense is if you decide that you want to, again, accelerate on the amended return those capitalized costs, you're going to have to make a corollary adjustment to your research credit calculation. Because when in 2022, when the TCJA rules came into place, it was probably just a drafting error, but there was a taxpayer favorable provision for the way 280C was applied to research credits. That the 280C is now also reverting back to the pre-TCJA language. And so for most taxpayers that used to elect 280C, that's probably going to be something they're looking at again. So if you amend your return to accelerate those 174 costs, you also need to apply the old 280C rules. And that means for most businesses, you're going to be losing about 21% of your credit that you would originally file. And given that amended returns are taking up to 18 months to process, and you have the ability to, on your 25 returns, elect to otherwise accelerate those deductions, for most taxpayers, it's not going to make sense. Even for small businesses, it's not going to make sense to amend your returns because, again, you will have a smaller research credit that comes with that acceleration. And the reality is before that return is processed, it may take some time for you to even see the cash coming back from it.
Yeah, thanks, Kathleen. And then real quick, on the transition rules for other taxpayers, a few issues that pop up or that we're seeing pop up, right? Just from a transactional perspective, there's some issues, particularly in the partnership context involving transactions with partnerships. If the rules provide that the deductions, although it's a change in method of accounting, it's not a 481A adjustment. So there's some considerations around how do you view it from an extraordinary item for allocation purposes? Is it mandatory to allocate under certain rules, or do the parties need to agree to it? So, it's something to keep on your radar. And then also, what the characterization of the deduction is, whether it's, ordinary deduction, or does it retain its character as depreciation or amortization, which is a significant issue for taxpayers that are subject to Section 163J and the ability to add back the acceleration amount in their 163J calculation that we talked about now that we're in the EBITDA regime again. I think with all this guidance and the elections, right, we'll certainly see some procedural rules from the IRS on how to implement these elections. And I wouldn't be surprised that, although there's not clarity right now, particularly as we see guidance on how taxpayers make this election, we'll see some clarifications, which will probably provide additional insight for taxpayers to make a decision on how to treat some of these items and whether to take advantage of certain elections or not. On the next slide, there's, some of the items we talked about. There's corresponding modifications to certain provisions. We had the 10-year write-off under 59E, Section 280C reductions, some clarifications there. Kathleen, I don't know if you want to hit anything real quick, but these are just sort of the coordination provisions that were updated in light of Section 174 Cap A.
I think the only thing I would emphasize is it is critical that taxpayers do some modeling to figure out, because you do have options for 2025. You can continue to amortize over the lives that you currently have for the 22 to 24 capitalized costs. You can accelerate the balance into 1 year. You can accelerate it into 2 years. But if you look at all the changes together, it's not just a 174 change, but we're going to talk about bonus depreciation in a minute. So there'll be additional costs related to that are going to be accelerated. So there's going to be big swings potentially in your taxable income. And there are a lot of provisions that are based on taxable income. So, and I think that, again, this polling question that Kevin has up kind of ties into that. So it is very important that you model all these different options out to figure out what makes the most sense for you.
Yep, that's right. And one thing just to highlight as we move on to, additional first year depreciation is that, taxpayers that might be an applicable corporation or subject to the corporate alternative minimum tax, right? 174 cap A or just 174 expenditures in general, aren't a preference item, and there's not an adjustment in determining your AFSI. So certainly make sure you think through that, because an acceleration of all those expenses could certainly have a negative consequence when you're looking at it from a corporate AMT perspective. So I guess, yeah.
So we're going to launch the polling question. Apologies for those that should be able to answer the question now is which OBBBA changes will most significantly affect your taxable income? 163J, 174, 168, which we're going to discuss, none of the above, or you're unsure. For technical issues, just continue to answer these questions. If you missed the first one, you'll still be fine and qualified for CP so long as you answer the remaining questions. We're going to leave this question up for a period of time, but while doing that, we're going to continue discussing 168. So the slides won't be advanced just yet until we have the sufficient response. But why don't we start talking about the bonus depreciation?
Sure. So another taxpayer favorable provision is basically we're going back to 100%, and this is permanent. It was obviously phasing out over time with the TCJA return of bonus depreciation, but now it's back at 100%, and it's currently permanent in terms of, so no expiration date for bonus. And a couple of things that we would call out, though, to make sure that companies are thinking about, because I think the initial reaction of some of our clients was, oh, this is great. I can deduct all of my depreciation costs now. And the way the legislation was drafted, there is a written binding contract call out for bonus eligibility. And again, 100% bonus applies to property acquired, but only if there was not a written binding contract that was in effect before that January 19th date. So this is not, you can deduct 100% of your costs of your assets that were placed in service in 2025. You do have to look, and especially for larger assets that, custom build type of things, it is very likely that you had a binding contract that was already in place at the date that's called out in the statute. So it's very important that you look at, especially costs near the beginning of the year that might be close to the cutoff anyway. And if you look at, again, what a binding contract is, there is research that we've done under earlier tax bills. A written binding contract is technically, it could be a purchase order. I mean, if you look at a lot of purchase orders that companies have to buy equipment, there's terms and conditions in there. There's all the things that are generally required for something to be a contract. And obviously there's state law issues that have to come into play. But just know that a rule is out there, and it might be something that would limit your ability to claim that first year depreciation. There is some transition elections that are available. Again, after you do your modeling and you look at, because we've had a couple, clients that they're concerned about CAMT and the implications that are going to come with all these accelerated costs that might come into play. That would be another election that should be considered.
Yeah, well, just to clarify, right, bonus depreciation or depreciation in general, particularly for 168 property, is essentially an adjustment for AFSI. So you would sort of substitute your book or your tax depreciation when you're doing your AFSI calculation. But certainly from a long-term perspective, you want to make sure you're modeling that out. And as Kathleen mentioned, right, the written binding contract, the key issue is whether it's enforceable under state law. And for those acquisitions around the beginning of the year, it's sort of definitely worthwhile taking a look, including like asset acquisitions. If you have a transaction, just understanding the mechanics of that deal. There's
just one thing, Rafe. Sorry, just on that. Trying to be mindful of the time, because we did get a question about the date, January 19th inauguration. So it was a matter of trying to say anything that was purchased afterwards would be eligible. And I want to note, it's not limited to 2025. So if you make an agreement, as of January 1st, we're going to purchase this property from you over the next 5 years. Because it was a written binding contract, as of January 1st, even 5 years from now, you'll be dealing with this. So taxpayers really need to be mindful of what you are or aren't doing. So just throwing it out there. But in the interest of time, do we want to jump to 168N?
Yeah, I think that's great. And so, the new provision added by OBBBA is Section 168N, which provides taxpayers the ability to make an election to recover 100% of the costs related to qualified production property. On here, we have a number of requirements that you'll see around what is qualified production property. It's property subject to Section 168. It's the, taxpayer uses the property as an integral part of qualified production activity. It's, placed in service in the U.S. or possession of the U.S. The original use has to commence with the taxpayer, and the taxpayer elects to treat the property as qualified production property. There's a number of questions that pop up in trying to interpret these rules because it's a completely new provision. You do have the written binding contract provision that comes into play here. But then really, I think a question that we have been looking at with some of our clients is, what is an integral part of a qualified production activity? And really it's, what is substantial transformation? Because that sort of is what's driving the definition of what is manufacturing, production, and refining. And, Kathleen, I know you've had some conversations with clients as well as yourself. Kevin, if you want to share any thoughts on, substantial transformation.
I think the one thing is that when this first came up in the tax bill, in the House version of the bill, a lot of people were thinking, oh, this is like 199, at least 199-esque in terms of how it was being applied. And if you recall, under that old rules, it was the manufactured, produced, grown, or extracted, the MPGE concept. That is not, this is much narrower in terms of how it's being applied. The software is not included here. There's some other specific called out type activities that don't apply here. The term production is specifically defined to cover the chemical industry and agricultural industry. So it is much narrower in terms of the types of activities. And as you mentioned, in terms of what is a substantial transformation, that's a key term here. It's specifically referenced in the context of 954 and some existing guidance that already exists there. So it is very important to make sure that, again, you're documenting that you actually have qualifying production activity. And The other thing that we would note is, again, there's questions like it has to be original use. And so if you are doing an expansion to an existing facility, is that enough? We're thinking as long as it truly is, a new capacity, expanding the footprint to some material manner, that it's going to fall under those rules. But again, we need the guidance to make sure that we understand how some of those nuanced words are going to be applied.
Yeah, I think that's right. If you're assembling product under the 954B regulations and what's defined as substantial transformation, some of those examples might catch you by surprise. So definitely think through those and take a look if you're in that situation. I think Kathleen hit on some of the qualifying property aspects. And then we have, two last points to hit on for qualified production, just that there's certain recapture rules that can come into play. And that's including recapture if you cease to use the property as QPP during the 10-year period. You may have recapture there. So that's something to certainly keep on your radar. And then here you see the effective dates or applicability dates of, when the property has to be placed in service prior to 2031. But then, construction has to begin for the property as well within a specified window. And so those dates are going to be relevant as we mentioned. So I think with that, Kevin.
Yes. So we're gonna launch the next polling question while I talk about what's next. And the polling question is, what guidance do you think is most critical? 163J, 174, 168, and international CAMT. So ultimately, when you think of what's next, there are a host of planning considerations. We've already touched on a host of them as to what are the effective dates, and there are multiple effective dates. Some of them are tied to the inauguration. Some of them are tied to the date of signing, which is July 4th. Some of them are tied to calendar years of 2025 or 2026. And so as a result of it, when looking at each individual provision, it's going to be important for everyone to be focusing on each individual provision as opposed to thinking that you can do a one-size-fits-all as to application. Obviously, all eyes are looking to Treasury and the IRS as to what's next. Also, we're looking to the OECD and whether or not the G7 agreement is going to come to fruition, which is, will the US tax regime be viewed as side by side? That's going to be key as we think about whether or not to 899. So just being mindful of what's coming down the road. Obviously, Republicans have said that they want to have another reconciliation bill, so we're not done just yet. It'll be interesting to see what gets included. And if you have any thoughts on what you think might be included, feel free to drop them in the chat as a Q&A of, I think it's this. But with that, Nate, what should they know about Answer Connect?
Yeah, great question. I appreciate you taking the time to kind of introduce that and set it up here. So let me go ahead and start the screen share, and we will jump into CCH Answer Connect, and we can take a look at all of the wonderful resources that are available in there to help you and help you as you're kind of working through the types of questions that we've raised on the call here today. So I think we see CCH Answer Connect coming through on the screen here. And the first thing that I want to point out is that we have full extensive coverage of exactly what's in the One Big Beautiful Bill Act, or the OBBBA. We have our explanation and analysis that we released on July 4th. So the same day that the law was signed, we launched our explanation and analysis. And this is going to be a full breakdown of every single provision that exists inside of the OBBBA, where we go through every single provision. This is kind of an overview of the table of contents. I'll just kind of scroll through all of it. We've got the whole bill covered in here, or the law covered in here, individual provisions, business provisions, basically anything that you could need related to the OBBBA is all inside of Answer Connect. And we have our editorial commentary written about every single one of these topics. And again, you want to dive in and read about kind of what our editorial team says these things mean. We've got all of that content available in there, ready to go. and they're at your fingertips to interact with. And what I also want to point out is we also have a very powerful new way for you to interact with all of this OBBA content. We recently launched our AI assistant inside of CCH Answer Connect. So instead of having to do your research the traditional way, which you can still do if that's what you're most comfortable doing, but if you want to use more of a generative AI research experience, you can use our AI assistant to do that. And for example, here I can ask the AI assistant to go through and say, hey, can you summarize the pre and post One Big Beautiful Bill Act changes for Section 163J, Section 174, and Section 168N? Those are the topics that we talked about during the webinar today. And because Answer Connect has basically the history of the entire Internal Revenue Code going all the way back to when the original Revenue Code was started back in 1913, we have a fully annotated version of the Internal Revenue Code basically in a post-OBBBA state and, more importantly, in a pre-OBBBA state as well, which means that we can go through, let me just rerun this again here, apologize for that. We can go through and do a quick comparison between basically the pre and post versions of all of these tax provisions and give you a nice highlighted summary of what that's going to look like. So again, this feature is live out there now and should be available for you to use to kind of ask all of your questions. Here we go, it's coming through this time. It might have just been a timeout issue previously. And you basically get for each one of the provisions, what happened in a pre-OBBBA perspective. So for Section 163J, what was the pre-OBBBA rules? And then what are the post-OBBBA rules? You have that for 163J, 174, and 168N all summarized. And then we link that down into our explanations and analysis sections where that content was drawn from. And one thing that I'll point out is that all of the answers that you get from the CCH Answer Connect AI assistant are all driven and summarized only from the trusted editorial commentary and content that we have inside the boundaries of the CCH Answer Connect library. So what I can do now is ask the AI assistant for what types of analysis should I be doing to see what types of tax savings will be realized under each provision. Be specific with the types of things I should be looking for and maybe what dates I should be paying attention to. And now you can go through and kind of have like a personalized or tailored action plan that kind of help you go through as you do your modeling, you do your scenario planning for each one of these areas. So again, you kind of have the items under 163J, under 174, and 168N, and then just some general steps for analysis there. And then if you wanted to jump in a little bit further and say, hey, maybe I'm a manufacturing company and you want to start feeding in some of your own, situation that you're dealing with in terms of the industry that you're in, the type of entity that you're structured as, anything like that, and ask if there's any other analysis that you should be considering, and if so, what are they? Can you basically write me a memo to summarize what I should be doing here? You can go through and do that. And if you're a manufacturing company, it'll maybe call out some other provisions that you should pay attention to, some changes to the manufacturing credits, for example, potentially 179, maybe if you're small enough to qualify for that. And then there's also some different state tax provisions that might come into play as well because of the interaction that they have with things that change from an OBBBA perspective. And then you also kind of have those highlighted key dates that we talked about previously in the presentation. Those are called out automatically. So you'll see that January 19th of 2025 item that we were just talking about in Section 168N. It calls your attention to that. And again, it kind of walks you through what you should be doing. And then if you want to summarize all of this down, you can just ask it to create a memo for you at the end. And it'll go ahead and kind of close all this research down into a memo/action plan that you can then execute against to kind of continue your research from there. So a lot of really powerful content that we have inside of Answer Connect. Again, having this AI assistant in conjunction with all of the new OBBBA content that we've launched as well, really powerful tool to help you go from basically researching and not being sure on exactly how this tax law is going to impact you, to go from not being sure to being sure, and then being able to go from being sure to being able to take action. All of that in a very easy to use, easy to understand conversational AI interface. So really excited about what we're doing here at Wolters Kluwer with CCH Answer Connect and the OBBBA and conversational AI and Answer Connect as a whole. Really powerful platform. And if you're interested in hearing more about it, certainly take some of the polling questions that we'll have coming in at the end here. But that is all that I have for you for today. So thank you so much, everybody. I'll hand it back off to Margaret to close us down.
All right, thank you, everybody. That wraps up today's webinar. I want to thank everyone for their participation today. I want to thank our speakers as well, and Nate for that very quick demo at the end there. As a reminder, CPE credit will be posted within 5 business days. Today's webinar has also been recorded, and you will receive an email with access to the link shortly. And then as a reminder, if you would like to learn more about CCH Answer Connect, please let us know in this polling question that is live. We thank you all for attending and have a great day. I'm going to leave that polling question up for a couple more seconds, but thank you all.